Are you a first-time RV buyer in the United States? Great, you're gonna wanna watch this video. Welcome to HBRV Lifestyle. They call me the Honey Badger because I give it to you straight and transparent about the RV business. I'm gonna go over the loan basics, the RV loan and financing basics to help you have a better understanding and get through all the mass confusion that's thrown at you, not only by your friends and family, but by the internet as well. So let's get started. To help make this easier, I'm gonna break this down into sections. The first section is gonna be what the terms of the loans are going to be. I'm gonna cover whether you have really great credit or whether you don't have such good credit. The second thing I'm gonna cover is how an interest rate is calculated by the bank or credit union. The third thing I'm gonna cover is what type of credit you need. Not just your credit score, but what type of credit you need. And finally, the fourth thing I'm gonna go over is overall what the bank actually is looking for proof of income, proof of residence, things of that nature. Okay, let's get started. All right, get a piece of paper and a pen out. You're gonna wanna take some notes. Now, if you have any questions, by the way, please leave them in the comments section, or you can go to the description box and you'll see my Gmail there, and you can always email me any questions that you have. You'd be surprised, I answer them all. It might take me a little time, but I do get to everybody. Okay, terms of the loan. This is the most confusing part. That's also the simplest part. And the reason being is because the first thing that you research when you go online and you look up RV loans is there's a bunch of people that tell you can get a 20-year loan on an RV, but there's no specifics added to it. Now, I did a video 2 years ago that explained those specifics, but it's a really bad video. That's why I'm doing this updated version. Boy, my videos were bad back then. Okay, anyway, moving on. A 20-year loan is very possible if you have really good credit. However, the standard loan, whether you have bad credit or whether you have good credit, the standard loan for an RV, travel trailer, toy hauler, fifth wheel, motorhome is 10 years. That's the standard. And then everything else is kind of swayed by different circumstances, okay? Now, if you have not so good credit or bad credit, most of the time you're gonna have a loan between 10 and 12 years. And in some cases, depending on the dollar amount financed, you can go up to 15 years. So for example, and this is a standard example, there's some banks that make exceptions, but if you're financing between, let's say, $10,000 and $20,000, you're more than likely gonna get a 10-year term. If you're financing, let's say, $20,001 up to $50,000, then you're probably more than likely gonna get a 12-year term. If you are financing above $50,000, that's when they start going, okay, we might be able to do a 15-year term on that loan. Now, if you have really good credit, it's a little different. If you're financing $24,999 or less, let's say down to $10,000, most of the banks will do a 12-year loan. If you're financing $25,000 and above, then they will finance up to 15 years. And then if you're financing over $50,000, you're gonna go up to 20 years. All right. Now, the way a bank determines bad credit and good credit is very different than when you buy a house or buy a car or go get a loan from, let's say, a credit card company or unsecured loan. They look at it very differently. So here's an example of what I'm talking about. There are folks that had a 680 FICO score, which in the car business, it's considered prime credit. But a 680 in the RV world is considered subprime credit. So I'm going to go over that more here in the next segment. Okay, let's talk about interest rates and how they're calculated, okay? Now, a lot of people feel attacked or triggered when I talk about these things. So let me give you a little background into who I am, especially if it's the first time you've ever seen me. I have been in the RV business on the dealership level, on the manufacturing level, service, parts, sales, and finance for almost 15 years. For the last 9 years, I've almost done nothing but exclusively get loans for consumers to purchase trailers, toy haulers, and motorhomes. So I have a wealth of knowledge, so don't feel like you're getting attacked or triggered. Just follow along so that way you have the education, all right? Now, when I go to a credit union or I go to a regular bank, either way, there are several multitude of things that determine what the interest rate's gonna be. I have personally, over the years, when rates were at 2%, when rates were at 16%, where I would have two identical scores, two identical credit, two identical dollar amounts, and they both end up with different interest rates. So it's not one size fits all, unfortunately. But by the time the end of the video comes around, I'm gonna give you some tips and secrets on how to set yourself up pretty good. Now, the first thing that really determines the interest rate is the dollar amount financed. When you're taking out a loan for, let's say, $250,000, you're gonna get a lot better interest rate with a credit union or a bank than you will at $10,000. Now, a lot of that also is determined by the second factor, which is the term of the loan. This affects credit unions more than it does the regular banks. For example, Huntington National Bank gives you a 1/4 point better interest rate if you go down a term. Meaning, if you're financing $100,000, instead of going 20 years, if you went 15, they would give you a 1/4 point deduction. With a credit union, it's absolutely determined by the term. So, like, for example, I have a credit union right now in this market, in the 2023/2024 market, that is advertising 7.99%. That's on an 84-month term. But when we go up to 180 months, it goes up to 9.74. So that's just a quick example of how the dollar amount financed and the term of the loan can affect the interest rate. The third thing that affects the interest rate is going to be your percentage of down payment. This is where it gets kind of complicated. So first off, they want you to put money down the majority of the time. Are there 0 down loans? Absolutely. Are there 5% down loans? Absolutely. But if you put 20 or 25% down on a loan, you're gonna get a better interest rate than if you put 0 down. And a lot of times it's a pretty big spread, okay? Now, some folks will go, well, I'll just go to my credit union. We use credit unions all the time, really good ones, probably the top 15, 20 credit unions in the United States. I use them all the time, okay? A lot of times when you go 0 down, both the bank and the credit union are gonna be about equal when it comes to the rate because the term is determined. So the advantages, and I'll go deeper into this in the next segment, but the advantages to using a regular bank over a credit union is the banks will do longer terms than the credit unions do. And I'll go into why we use credit unions later on too as well. So you're gonna wanna keep going on this video so you get all the information. Okay, last thing that determines an interest rate is your credit score. Now, your credit score is not only what the FICO score is, but also what the internal bank score is. I have personally seen in the last 5 months that I've been doing this, and it happens off and on, where I had somebody with absolutely a perfect FICO score, perfect credit, and the bank scored them a tier 4. And then I've seen somebody with a really good credit score, but not perfect, be a tier 1. So a lot of it has to do with internal scoring. A lot of credit unions are now going to an internal scoring system. So again, that's why I said not one size fits all when it comes to the basics of how RV loans work. Okay, so the next thing we're going to talk about is what kind of credit you need. If you're finding this content helpful, please help us out and hit the like button and subscribe to the channel. Okay, credit and credit history are very, very hard to explain. The only easy part of explaining this is the minimum FICO score. The minimum FICO score required is 575. Now I'll let you have about 2 seconds. 1, 2, because you're probably going, what? No, it's true. Most of the time, if you have a 575 score along with some other things, you can get into an RV loan. You may not like the interest rate, but you can get into an RV loan. Okay, what those other things are, and this is with outstanding credit too, guys, is installment history or installment loans. Now, if you don't know what that is car loans mostly. That's the best way to tell you, like a car, a motorcycle, something that is a regular loan that you make over, let's say, a 5 to 8 year period. Now, how they look at that is very different than how you and I look at it. For example, I know a lot of friends of mine that have cash in the bank and have to liquidate funds. So they go down and they like a truck, they buy the truck on credit, the funds come in, they pay it off. The bank doesn't like that, okay? Now, I'm gonna give you another example that's a great example. You take out a truck loan and you take it out for 2+ years, meaning you carry the loan for 2+ years. Doesn't matter if you pay it off in 2+ years. What matters is you carried the loan for 2+ years, then they will consider that a loan. So for example, if you made 3 years of payments, let's say your term on the truck was 8 years, but you paid it off in 3, they still count that as a loan. If you took out a truck loan for 6 years and paid it off in 6 months, they're not going to consider that a loan. Now, that being said, installment history also determines the dollar amount that you're going to qualify for. So for example, if you took out a car loan for $25,000 and that's the highest you've ever had, and you made that payment for more than 2 years, you carried that loan for more than 2 years, then more than likely a credit union or a bank will give you a $30,000 or $35,000 loan on an RV. Now, there are exceptions to all these rules. They're very few and far between, and I go over those later on in the video. But I'm gonna say that 85% of cases, this is how it works. Now, if you have really good credit, here's the difference. If you have really good credit, then they may give you credit for the mortgage. So here's kind of an example. Let's say that you took out a $50,000 truck loan. You carried it for more than 2 years, and you've had a mortgage for 10 years for $200,000. The bank may double what your car loan was, your highest car loan. So if your highest car loan is 50 grand, they might give you 100. Now again, those start becoming more complicated, and in the description box below, I'm gonna link a video for jumbo loans, because that's a whole different animal. Jumbo loans are anything over $100,000. So in all reality, your car loan history has more effect on how much of a loan or your ability to get a loan than your FICO score. Does that make sense? If that's complicated, guys, let me know in the comments section or send me an email and I'll try to break it down a little bit simpler than that. But that's pretty simplified. The next thing they look for in your credit history is how much you have available on your credit cards. Now, the rule of thumb, which has exceptions, of course, the rule of thumb is that the banks and the credit unions want you to have at least 65% of your credit cards available. Meaning this, I'm going to give you two examples, make them real easy numbers. So if you have $10,000 in total credit card available balances, meaning total between all your credit cards, you have $10,000 available, they want you to have no more than a $3,500 balance, okay? Let's use a smaller number. Let's say that you have a $2,000. You've taken out several credit cards and they total up $2,000. They want you to have no more than a $700 balance on those said credit cards. So what we call in the biz 65% available revolving. Now, the exceptions are few and far between. A lot of times your down payment, the amount financed, your credit history, there's a bigger, broader picture, but that's kind of the rule of thumb of what they look for, okay? The very next thing they look for is what kind of derogatory credit you have, the type, okay? And the type meaning bankruptcy, foreclosure, repossession, charge-off, things of that nature. The least amount they look at is medical. They don't look at medical as heavily as they used to. So if you have medical bills, you can kind of like, I can probably get away from it. But they look at student loan debt differently, and I'm going to go into a different video about that later on this month. But student loan debt really affects your credit. If you have a bunch of student loans, you need to see that video. I think I'm going to release that right before Christmas of 2023, by the way. I forget people actually watch these for the last 2 years. Anyway, moving on. Where was I at? Oh, I remember where I was at. Duh. Okay, so let's say you had a bankruptcy. The way a bankruptcy works is they want you to have a reestablished set of loans. First of all, the bankruptcy you have to have, basically it has to have been discharged for at least 2 years. Meaning if you filed in 2018, but didn't discharge till 2021, you're in the clear right now. But what they want to see is after the bankruptcy, what kind of car loans did you reestablish? So credit unions and banks all want to see that you made another car loan, you made it on time every single month, and you paid on it and carried the loan for at least 2 years. So basically, folks, if you have filed bankruptcy in the past, okay, and it's been discharged, you're starting all over on a credit union and bank's mind. You can't just simply walk in and go, okay, I'm a year discharged from my bankruptcy, I have no reestablished credit, I'm ready for an RV loan. It's not the way it works. They want you to get a couple credit cards, they want you to get another car loan, so that way they can see that, hey man, he's reestablished himself or herself and they've got themselves back together. So that's kind of how they look at it in that respect. Foreclosure on a house or repossession on a car, same scenario, okay? You gotta reestablish the credit. It's not what you did prior to the bankruptcy, prior to the repossession, it's what you did afterward that counts, and that's how they look at it. All right, time for the section that everybody that's self-employed gets mad at me for. Okay, here comes the hate, here comes the hate. All right, Don't shoot me, please. I'm the messenger. If you're self-employed and a bank or credit union is requiring proof of income, even if it's your local credit union, they want tax returns. This is a luxury item, folks. This is not a need. Like you go down and there's a lot of banks that will take bank statements for a car loan. They do not take bank statements for an RV loan. And a lot of the reasons why they do that, guys, is because the first thing to go in hard times, the first thing you're going to give up is the toys. And to them, a travel trailer, a toy hauler, a motorhome, those are toys. So they're very high risk loans. So they want to see what you prove to the government you make. This goes for 1099 employees as well. Now, that all being said, if you're a paycheck employee, oh, by the way, real quick note, if you're a Lyft or an Uber driver or some kind of driver in that respect, tax returns. Okay, now, for paycheck employees, you're a lot simpler. They need 2 paycheck stubs and a W-2 form for the year prior's taxes, sorry. Okay. Now, that being said, what they're looking for when they ask for proof of income is they're looking for debt to income ratio, or DTI. They're looking for you to have 35% or less debt to income ratio before the new payment. Not after, but before. That's the world they kind of live in. Now, sometimes they'll make small adjustments, sometimes they'll make small exceptions here and there, but for the most part, they want to see you, if you have, let's say, $5,000 coming in before taxes, not after, but before. If you're making 60 grand a year before taxes, they want you to have no more than $1,750 going out between your rent, between your mortgage payment, between your car payments and your credit card payments. Let's use a little bit larger number. Let's say you make $10,000 a month. They don't want you to have any more than $3,500 going out. Now that's where I'm going to segue into a co-signer or a co-applicant. Let's say you have a spouse that works too. They will consider her income and her debt to income ratio separate for anything she or he has that's not on your credit report as well. Now going into that, let's say you have a spouse and you both split the bills evenly, but yet you have part of the credit and she has part of the credit. In essence, they want you to have joint credit on a couple of loans. They don't want you to have like 2 separate things. Otherwise, what they're going to do is they're going to consider you both individually instead of one joint family. I've had that happen before. I've had it happen where I've had a husband and wife that have been married 12 years, but they never had a credit card together. They never had a car loan together. And I'm not talking about authorized user. That doesn't count. I'm talking like hard inquiry loans. They never had it together. Never even had a lease together. So they had to be considered separately. Okay. Last thing that they really look for in a lot of cases is proof of residence. And this is where full-time RVers run into a lot of issues. If you're already at a full-time RV capacity where you have no physical address, you're going to have a tough time getting a loan because most of the time, not all the time, about half the time, they want to see a utility bill that goes to the address you claim you live at. Not all the time. Obviously, if your credit report has reflected the same address for 10 years and they Google your address and it hasn't sold and it still has the same owner for 10 years, then obviously they're probably not going to ask you for proof of residence. But if you've moved around, let's say you're in the Navy or the Army or whatever the case may be, and you've moved around every year and a half, 2 years because of orders, or maybe you're a lineman and you're going down and fixing all the power lines, or you work on oil rigs, you move around a lot. So in that case, you want to make sure you have some sort of utility bill in your name at the physical address that you claim you're going to be at. Whether they ask for it or not, hey, it's a whole different scenario. But if you're prepared with it, then you're going to have less issues. Okay. Now, if you go up here, right up here, there is actually a playlist that gives you every finance video I've done. And if you scroll through, it'll give you things from good credit, bad credit, self-employed, jumbo loans, all kinds of stuff. Okay? We'll see you next time.